Get your popcorn ready. Tomorrow, this time, we'll know 3 hours right here. The Fed, meanwhile, watching the tight labor market as it tries to get inflation under control. Wage growth up 4.6% since last year. That's about a full percentage point over where the Fed wants it. We'll get a new reading on wage growth this Friday with that jobs number. For more on where we're headed, we turn to Mona Mahajan, Edward Jones, Senior Investment Strategist. Nice to see you. What do you expect we will learn on Friday?
On Friday, which is the jobs report.
Yes.
That will actually be a very telling Friday. In fact, not only because we'll get, of course, a non-farm jobs number, which is expected to decelerate. Keep in mind, last month we were over 200,000 new jobs added. This month we're expected somewhere closer to 185,000. The unemployment rate, though, is expected to tick up, but only slightly, from 3.5% to 3.6%. Still near multi-decade lows. And then, as you mentioned, the key, at least for the Fed and for the inflation front, will be that wage growth number. Now, the expectations are actually for wage growth to be somewhat steady from last month at that 4.6, 4.7% year-on-year growth figure. What the Fed has told us, though, it would like to see that wage growth figure move closer to about 3.5%. That's more in line with about a 2% inflation rate in their mind. Now, keep in mind, this morning we did get interesting ECI, Employment Cost Index data. That also moderated down to about 1% quarter over quarter. That was below expectations, perhaps why we're seeing a bit of rally today as well. So we're looking for the unemployment rate. We're looking for certainly wage growth on Friday as well.
So, Mona, then what is, in terms of the data that we do have, because we've got the Fed decision tomorrow ahead of this jobs report, what does that signal just in terms of what you're expecting to hear tomorrow from Jerome Powell?
Yeah, it's interesting. We're coming into this Fed meeting with a market that is in rally mode, essentially. The S&P 500's up 5%. NASDAQ's up closer to 10% in this 1 month period. Keep in mind, from a Fed perspective, they're not necessarily keen to see financial conditions easing and easing pretty substantially in this 1 month. So perhaps we'll get a little bit of pushback from Jerome Powell. He might reiterate, of course, his ongoing messages. They are not done raising rates. They perhaps have one more to go. And of course, they are nowhere near considering rate cuts. Now, keep in mind, markets are starting to price in rate cuts by year end. The Fed has been pretty consistent that they will keep rates at an elevated level, perhaps around this 5% range for some time. Now, we'd also expect Jerome Powell perhaps to comment a little bit on what they're seeing in terms of inflation trends. Last meeting, they bucketed inflation into 3 categories: goods, housing, and then the services inflation. Now, goods is starting to roll over. Housing is showing signs of cooling. It's really the services component, which is driven by that labor wage growth that continues to remain elevated. So perhaps some color there would be interesting as well.
And the markets really don't believe the Fed is going to stay, believes it's going to cut in 23. Where are you on that?
Yeah, in our view, we think that it's likely that the Fed will start to at least signal rate cuts by year end, even if they don't execute them until early next year. And that's for a couple of reasons. One, if we do get an economic slowdown, that's one of their tools in the arsenal. But more broadly, at a 5% or so Fed funds rate, they're well above the neutral rate. And at some point, they will have to start thinking about bringing that, at least in small increments, back down to perhaps a neutral, which may be anywhere from 2.5%. So we think, barring any shocks in inflation and growth, they will probably start thinking about that and maybe signaling that by year end.
Well, we're starting to certainly see some cracks in the consumer retail sales following last 3 of the 4 reports that we've had. Certainly, when you take a look at some of the other trends, housing market continuing to weaken a bit. What is the signal just in terms of the odds of a recession? Any hope that we could potentially avoid one?
Yeah, it's interesting. Our forward-looking indicators still point to a mild recession sometime, beginning in the first half of 2023. But, some of the trends that we're seeing, not only in the better inflation figures, the resilient labor market, but also, this ongoing resilience coming from Europe and the reopening in China, this has led to better outcomes across the board. So to us, whether we fall into an actual technical recession or a period of below trend or below potential growth. And potential growth in the U.S. is somewhere between 1.5% to 2%. We certainly think we could enter a period of softer growth. It will be tough for the markets to completely ignore this and power through. So we would expect some periods of volatility. But what we've been communicating is that that period of volatility could, in fact, be an opportunity then to position for maybe a more sustainable rebound ahead.
All right, hope so. Mona Mahajan, great to see you. Thanks so much.
Thank you.